Our next slide talks about ethics because this is one of the most important concepts in accounting. We have many of our rules and regulations that are a result of unethical accounting practices in the past. After you take the CPA exam, there's a second exam in order to get your license that is all about ethics in accounting. That's how important this is. So, what are ethics? It is the difference between right and wrong, honest and dishonest, fair and unfair. In accounting, when we are deciding if something is ethical or not, we ask ourselves, what would a reasonable person do in the same situation? Now, in accounting, there's very little gray area. Most actions are either one or the other. For example, don't steal money, don't share confidential client information, don't make false transactions. In the past, there were many scandals and fraudulent accounting happening. Investors started to lose confidence in the American stock market, and we need investors in order for our corporations to grow. One of the biggest and most known scandals is from Enron. If you haven't heard of Enron before this, don't worry, this is just the very beginning. You will hear about this company in many future business classes that you will have. I have a short video that describes what happened.
Enron used to be the seventh largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below a dollar in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
So, what did they do after investors lost confidence in the financial market? Congress passed the Sarbanes-Oxley Act of 2002, also known as SOX. SOX not only affects accountants, but business managers as well. This won't be the last time you hear of SOX. SOX has helped promote independence, meaning those with a bias or vested interest cannot perform audits, more transparency in their financial reporting, more management involvement, which includes CEOs signing off on financial reports. Currently, around 25% of all CEOs have an accounting background. It has also provided more severe penalties for those that do perform financial abuse. There are some very interesting movies involving financial crimes that I recommend watching, such as Too Big to Fail, The Smartest Guys in the Room, and The Big Short. Congress has also enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, which promotes accountability and puts an end to bailouts and this too big to fail notion. Lastly, we're going to discuss the fraud triangle. This is something we're going to discuss more in a later chapter. The fraud triangle consists of 3 points that, when present, increase the likelihood of fraud occurring. It does not mean that fraud will 100% occur or that these 3 points are definitely needed for fraud to occur, but the chances do increase when one or more of these factors are present. The 3 points are opportunity, pressure, and rationalization. I'm going to play another video that does an excellent job explaining what these three factors mean.
If you ask people whether they think stealing is wrong, most of them would answer yes. And yet, in 2013, organizations all over the world lost an estimated total of $3.7 trillion to fraud. which includes crimes like embezzlement, pyramid schemes, and false insurance claims. This wasn't just the work of a few bad apples. The truth is that many people are susceptible not only to the temptation to commit fraud, but to convincing themselves that they've done nothing wrong. So why does fraud happen? While individual motivations may differ from case to case, the fraud triangle, a model developed by criminologist Donald Cressy, shows three conditions that make fraud likely: pressure, opportunity, and rationalization. Pressure is often what motivates someone to engage in fraud to begin with. It could be a personal debt, an addiction, an earnings quota, a sudden job loss, or an illness in the family. As for opportunity, many people in both public and private sectors have access to tools that enable them to commit and conceal fraud. Corporate credit cards, internal company data, or control over the budget. The combination of pressure and being exposed to such opportunities on a daily basis can create a strong temptation. But even with these two elements, most fraud still requires rationalization. Many fraudsters are first-time offenders, so in order to commit an act most would regard as wrong, they need to justify it to themselves. Some feel entitled to the money because they are underpaid and overworked, and others believe their fraud is victimless, perhaps even planning to return the money once their crisis is resolved. Some of the most common types of fraud don't even register as such to the perpetrator. Examples include employees fudging timesheets or expense reports, taxpayers failing to report cash earnings, or service providers overbilling insurance companies. Though these may seem small and can sometimes only involve hundreds of dollars, they all contribute to the big picture. And then there's fraud on a massive scale. In 2003, Italian dairy food giant Parmalat went bankrupt after it was found to have fabricated a $4 billion bank account and falsified financial statements to hide the fact that its subsidiaries had been losing money. Because it was family controlled, corporate governance and regulator supervision were difficult, and the company likely hoped that the losses could be recouped before anyone found out. And it's not just corporate greed. Governments and nonprofits are also susceptible to fraud. During her time as city comptroller for Dixon, Illinois, Rita Crundwell embezzled over $53 million. Rita was one of the country's leading quarter horse breeders and winner of 52 world championships, but the cost of maintaining the herd ran to $200,000 per month. Because her position gave her complete control over city finances, she was easily able to divert money to an account she used for private expenses, and the scheme went unnoticed for 20 years. It is believed that Crundwell felt entitled to a lavish lifestyle based on her position and the notoriety her winnings brought to the city. It's tempting to think of fraud as a victimless crime because corporations and civic institutions aren't people. But fraud harms real people in virtually every case. The employees of Parmalat who lost their jobs, the citizens of Dixon whose taxes subsidized horse breeding, the customers of companies which raise their prices to offset losses. Sometimes the effects are obvious and devastating, like when Bernie Madoff caused thousands of people to lose their life savings. But often they're subtle and not easy to untangle, yet someone, somewhere, is left holding the bill.